Hi, this is Paul. Welcome to Wealth Protector TV. Join me on this episode as I sit down with top business attorney David Calderon, who is going to reveal his best practices for prepping your business for sale, when to start thinking about it, and how to get it done. Let's go jump in. Hi, this is Paul, and I see people are starting to join. Great to see you here. We're going to just give it some time here, a few minutes before we get going. And I did want to make an announcement here up front for those of you that are joining. I'm going to say this again, but in the chat feature, if you're looking at the chat, I put in there a link to get one-on-one with David as a follow-up. That's complimentary, but we always get questions from people about the content, and anything you want to talk about, get one-on-one with David. That's a link where you can get on his calendar straight away. So I wanted to mention that, and we'll be back in just a minute or two as we let people jump on here. Well, everybody, we're going to get going now. It's just a little bit past the top of the hour, and I want to respect everybody's time. And my name is Paul Hitchcock, and I'm with Barth Calderon. My colleague David is here. This is our channel, Wealth Protector TV, and we are an asset protection, estate planning, and business planning firm. We're celebrating our 30-year anniversary this year, and we have about 6,000 clients across the country, put on about 40 workshops a year to groups everywhere. David is one of our top speakers. We're located in Southern California, Orange County. You're looking at the building there. I think, David, your office is in the corner with the light on because you're always working late over there. And I want to say again, there's a link in the chat to get one-on-one with David for any follow-up questions. We will take Q&A during this talk. We're going to run it probably 25 minutes or so, and getting into selling a business and the strategies involved there. David is one of our top attorneys at the firm, asset protection, estate planning, business planning, and one of our top speakers that travels around the country giving presentations just like this. So David, let's get into this. I'm just going to let you start off on selling a business. What do we have to know?
There's lots of things you need to know, and actually, there are all sorts of reasons for selling a business. Sometimes people you have to sell a business. Things aren't going as well as they thought they would. So they got to get out. Sometimes people, they want to transition out of business, maybe do something else. A lot of our clients are entrepreneurs who set up startups and prep them for that eventuality that they're going to turn around and sell the business. Others, you may want to sell your business through succession planning to key employees, or possibly to your partner, for example, or partners, and want to transition out of the business that way. So there's many different ways of looking at selling a business, but really kind of the key is, once you make that decision, it's to start creating a checklist or a thought process of things you have to do to prepare the business for sale.
David, let me ask you a quick question on that. So when it comes to succession planning, we all hear about that, exit planning, succession planning. How far in advance do you recommend people start thinking about it? Because I've heard, it's 10 years, 5 years, not that they're going to sell the business right away, but they got to start thinking about the plan and never do it last minute. What are your thoughts about prepping to even start thinking about it?
Well, a well-oiled machine, meaning a business that has all its formalities taken care of, has all of its contracts wired in, that has its intellectual property protected, that has good systems in place, strong systems, both legally and from a business perspective, is going to be worth a heck of a lot more money than a business that does not. If the business is like too dependent on one person, or there's too much goodwill tied into one person as opposed to the business itself, it's always going to have less value because, let's face it, once the person who has the control of everything, or the goodwill, or where everything is just kind of up here in that person's head, as soon as they depart or something happens to them, the business loses its value because the value is in that individual. So, you need to think about, from a threshold perspective, do I have a business that I can sell, that's portable, that's something that someone's going to buy and and find worth in. And, you should start that thought process, immediately. And I think if you have an ongoing business and you have partners or you have employees, maybe you want to shed some stock or membership interest to, it's an LLC, think about who those employees are and start thinking about maybe transferring some of that, doing a buy-sell agreement that's tied into that. But buy-sell agreements should just be part of, you have more than one owner in a business, or if you have one owner in a business who has several key employees that they may want to do one-way buy-sells with eventually. Those are things that you should be thinking about in terms of just your overall business planning. If you're planning on exiting the business, selling it to a third party, you should still always constantly in the back of your head think about what's my exit strategy. Things could be going great guns, but still, you always need to think about when I want to leave the business, how do I want to leave it? And is the business prepared to be sold so I can maximize my monetary value that's tied into the business?
Okay, so start early, and I know you're going to get into some of the minutia here about what to focus on, but I think it's a fair statement too. I've heard you talk about this, that the reason you start early is that there are strategies to sell the business to employees or others that require a fair amount of time to let those strategies play out. Is that a fair statement?
That's a fair statement, and it's always good. I always think that the business people, no matter what your volume, what your size, you should always have people on your speed dial, professionals that you can talk to, especially an attorney and a CPA, or any people that do your taxes or what have you. So you can consult with them and start that planning process with them, and just ask the questions. This is my goal. Like, this is what I want to do. How do I start best accomplishing that? What should I do to get my ducks in a row? What are the things that I need to do now? What are the things I need to do maybe a few months from now? Or if you're in that position where, look, I need to get out immediately, then what do I need to do to tighten up my business and get it going so I can get the most value from it, whether I'm selling it to my employees or whether I'm selling it to a third party, an outside party.
Okay. All right. So the upfront thought process is done. There's a game plan there. Now let's get into the execution and some of the details of selling a business. What can we jump into now?
I think really still you need to focus on, what kind of business do you have, and whether is it a business that is solely dependent on your own personal goodwill, or is it something that maybe where you own some intellectual property, maybe you have a process or a brand or a trademark that has value, that you're going to pass along. You need to make sure that all of your legal documents are online. You're in good standing with the state. You need to make sure that you have if you have employees, you need to make sure that you have your policies in check, that those things are up to date. The contracts that you have with vendors and customers, how are they doing? What's your back office situation look like in terms of accounts payable, accounts receivable? What do you want to do with those? Are those things that that you want to sell, or do you want to leave out? Like, there's a big threshold issue as to whether or not you want to do a stock transaction or an LLC membership interest transaction, where you sell ownership of the business in its entirety to your employees or a third party, or do you just want to do an asset sale where you sell the assets that have value and the liabilities stay with you, or perhaps maybe you sell the assets and some liabilities to the other side, and all that will come into play in determining what the value of your business is. But the more preparation that you do, the more you think about these things, the easier it is for you to kind of figure out, okay, this is how I want to go about doing it, and even possibly bringing in somebody who can do an evaluation for you. There are people that do them somewhat cheaply, and then there are ones that are really expensive. They kind of set the target price and say, okay, this is what I have and what it's worth. And a lot of times during that process too, it's like going to a doctor and getting a physical. A doctor will examine you and say, hey, your heart looks great, this looks great, but you need to work on this, you need to work on that. They will come in and tell you that these are maybe deficiencies you have. And as I said at the outset, a well-managed, a well-constructed business that has processes, that has a way of doing things, is much more valuable a business that's kind of scattershot and dependent on the goodwill of say one individual.
Okay, so let's say you identify, I want to mention a couple things here. One, first is you identify management that you want to sell the business to. And then the second part of this is going to be if they're family members, closely held family business, bringing the next generation. But if you're identifying management to take over the business, what are some of the highlights here of how to structure the sale to management, the strategies for doing that?
There's all sorts of strategies that you can use. You could do what we call a one-way buy-sell agreement with employees or family or what have you, where if you're the sole owner of the business, you could pass it along to them in the event something happens to you, like either you pass away or you become disabled or you want to retire. You set terms for that transaction that provide them with an opportunity to purchase the business from you at a valuation that's done periodically. Like maybe you do it every year, every 18 months, every two. I wouldn't say go out over 2 years, but where there's a valuation done, they're clear on what the price is, what the terms are going in, and you can take care of it that way. There's also other ways of possibly you could gift an interest, a small interest that gets skin in the game for them, and turn around and then do the buy-sell agreement or something along those lines to kind of tie them in and also still create that structure.
Is the gifting, is that gifting phantom shares, phantom stock? Or
phantom shares is different. Basically, phantom equity is a situation where you don't want to pass along an interest in the business itself. It's more like an employee bonus, where basically they're compensated on the growth of the value of the company from either from the company from when it began to when it's sold or there's a triggering event, or from a point in time and when it appreciates value. So phantom equity, a lot of business owners like phantom equity, like doing that because they don't have to give up any ownership interest. They don't have to talk about the constant reporting requirements or things that you need to be done with actual owners of stock in the business, but they can compensate people that are key employees, key executives like owners, key salespeople, revenue drivers, for example, without giving them actual ownership. That's a different thing than selling the business. Yeah.
Okay. So then when you're selling the business and you're identifying management, what I'm hearing from you is the language of the buy-sell agreement is key, and that needs to be or can be tailored to how you're selling the company. But then how does management, how do they have the money to buy the company? How do you ensure that?
Well, you can use insurance to fund, say, if you have death or disability, you can buy insurance policies on yourself or on the owner of the business that help alleviate the burden for the employees to pay the price when it comes due. But you can also do promissory notes for any length of time. Some owners like to do the promissory note thing because it works as kind of like a fixed payment they get every month for the sale of the interest, and it also lessens the burden on the other people going forward. So the people that are buying the business, the key employees that you want to leave it to or take care of in that situation. So there's all sorts of different ways of funding it. There's all sorts of different ways of working with the terms to make sure that they can take care of that obligation when it comes due. Lots of different creative ways of doing buy-sell agreements.
Okay. And then what about a closely held business with family, bring in kids into the business? You get into, there's estate planning issues there too, right? In conjunction with selling the business. Talk a little bit about that scenario, bringing the next generation into a business, best practices and pitfalls.
Yeah, it's funny that you mentioned that because my family, I'm the seventh of 7 kids in my family, and my family is in the Mexican restaurant business, and I'm the only one that doesn't work like in the business. So in terms of it flowing from my dad to my brothers, I was kind of on the outside. I went to law school and got a law degree, practicing law for 30 years. But so there's always those dynamics. Some kids want to be a part of it, maybe some don't. And in estate planning, that has to be taken into consideration, obviously, with your kids in terms of how you divvy up your assets. Maybe some of the kids get value out of your estate by inheriting the business. Maybe others inherit other things or assets or what have you. So I think that's kind of the threshold thing, is like, which kids want to be in. And if that's the case, you can take care of some of that in your state. You could also take advantage of the gift tax laws to pass shares or interests in your company to your kids.
Oh, okay.
The estate tax exempt or the gift tax exemptions. And then on the other end, like you said, do buy sells to tie up the remainder of that. Also, you could possibly use trusts, things like that, to pass along equity in the company to gifting trusts for the kids, things of that nature.
Yeah.
It can get in a little bit into the weeds in terms of what you need to do estate and tax wise, but there are always options available to do that kind of thing. Now, obviously, selling to a third party, you don't have any of those things that you have to worry about. What you need to really, the estate and gift tax stuff, what you need to worry about with third parties is maximizing the value of your asset, which is the business.
Right. Yeah, it's interesting because, I mean, that's a topic for another day, is the whole estate planning scenario for business owners, but it is often overlooked when they're selling a business. They don't think about the tools, strategies that can be used within the world of estate planning to assist with a proper sale of the business and
Yes.
benefit them. Yeah. Yeah. David, what are some of the pitfalls or conflicts you see amongst multiple business owners in selling a business? Again, best practices when you got multiple owners of a business.
Well, obviously, I think and it's funny. Like I said, I mentioned about my family business experience, and they're often at loggerheads over all sorts of things, and so. Yeah. A lot of times, having a business and having a business partner is like basically having a business spouse or a business sibling, right? That you have to deal with on those types of issues. So I think in those cases, you want to try to get on the same page in terms of what the value is. Like, say, you're a 60-40, maybe you're the majority owner, you have 60%, the other has 40%. Maybe you want to try to cash them out before you put the business up for sale. Or maybe you're on the minority end, and obviously you're worried about, okay, I maybe don't have complete control here or any control. Right. How do I maximize the value of my minority interest? But I think in terms of open communication with each other, being honest in terms of, look, this is, if you're an owner, you've got skin in the game. These are what my future plans are. I'm thinking about exiting the business. I'd like to put it up for sale, and talking to them about, and including everybody in that game planning, what you're going to do. They may turn around and say, hey, look, you want to go? We'd love to buy you out. Yeah. Or hey, I just want to make sure that I'm part of this deal and I get drug along and that I end up with value for my interest, just like you're going to get value for your interest. And like I said, a lot of it comes down to even the structure of the sale. If it's a stock sale where somebody's buying the company and everything that's in it, or they're buying an asset, they're doing an asset sale where you're just buying pieces of the company and keeping some of the liabilities. And once that's done, then maybe distributed to the stockholders or the interest holders after the assets are sold and the liabilities are taken care of. So there's a ton of things to think about when you're trying to get up and going with the business. And you also need to think about when you invite a buyer in and the buyer comes in and gives you a letter of intent, maybe does some baseline due diligence and says, hey, I will offer you X amount of dollars to purchase your business. Then you're dealing with that buyer. In turn, you want to minimize friction in terms of the process of a sale. So yeah. Like I said, you want to make sure if you're doing it voluntarily, getting out of your business, you want to make sure that you have as many of your ducks in a row as possible before you put it on the market, or you're voluntarily, getting out and doing that sort of thing.
Okay. I want to encourage everybody that's on here too. If you have any questions, feel free to put them in the chat right now. We'll get to them. I've got some questions here that were emailed into us ahead of time as I was publicizing this event. I want to start mentioning some of those now, but please, any questions you have on anything, put them in chat. We'll address them right now. So some of the questions here, David, revolve around the structure of the business. Does it, I'm going to paraphrase here this question, a sole proprietorship versus a partnership, an LLC. kind of encapsulating two or three questions into one, but does it make a difference of how you structure your business? Is one better than the other, or?
I would definitely say that being incorporated or being a limited liability company makes it much easier to sell your business. So sole proprietorship, usually things are kind of wrapped up in the sole proprietor. So
Right.
all of the goodwill that the business has, all the intangibles are often dependent on the sole proprietor, whereas with an entity, a lot of those things are the property of the entity, and are sellable. But a sole proprietorship is always, and plus you have personal exposure with sole proprietorship. And I understand some people may not think I've got the money right now to incorporate, or I don't have the wherewithal to pay the $800 a year cost to maintain an LLC in California, for example, or what have you. But I think, it behooves you, if you're a sole proprietor, to look into doing that stuff and to formalizing your business and getting it out of your name personally, so your business kind of stands on its own.
With the corporation versus the LLC, if there are benefits, I know there are asset protection benefits from being an LLC, but I imagine everyone owns a business that's on the presentation here, but there's the Plan F reorganization you do. If somebody wants to convert to an LLC, and there may be reasons beyond a sale or including the sale to do that, there's the Plan F reorganization going from the corporation S Corp to an LLC, correct? And it's
S Corp or a C Corp to an LLC, and it's primarily an asset protection function to do that. Most new companies that start up from the ground up, or someone comes in who's a sole proprietor and say, hey, I've got this great thing I'm doing great guns business wise, but I want to protect myself more. 9 times out of 10 these days we'll recommend an LLC, and you can control the tax basis for that, whether you want to be taxed as an S Corp, C Corp, or have it taxes passed through to you, or a partnership. All things that you can do. Plus you get twice the liability protection that you do with a corporation. A corporation has certain asset protection benefits, meaning that it's harder for people from the outside to come in and liquidate your shares, but people can come up from the inside. If there's a liability against you, they can take your shares, and they sue you personally. They can take your shares and try to liquidate those and use that when they enforce a judgment. With an LLC, they can't necessarily do that. They have to get a charging order on the economic interest. That's a whole other kettle of fish and a whole other big discussion.
Right. I thought I'd bring it up because that came up, but I'm going to read this question for everybody. Thanks, Sean, for asking us. How would you address the California Bulk Sales Act if you are representing the buyer and the parties want to expedite the sale of asset agreement?
I think that you definitely need to comply with the California Bulk Sales Act. And as far as expedition, it makes it a little bit more difficult. I think there are ways that it could possibly be done, but you need to respect the UCC, and there's certain things that are baked into that in terms of the asset purchase agreement and things of that nature.
What is that, David? Just describe what that is.
What, the UCC, the Uniform Commercial Code, or
that Bulk Sales Act? The California Bulk Sales Act.
So it basically it protects buyers and sellers of goods, buyers and sellers of assets from certain things that the state is identified that they need to take care of. So bulk sales law has certain things regarding liens and notice and things that you have to do in that regard to comply. So it's a little more complicated, and it also can involve like bulk sales if you're selling inventory or things of that nature as part of the deal.
Got it. Okay. Great information here. Let's keep the questions coming. Can you respond to the Bulk Sales Act by an extended payment plan with stipulated warranties? Any comment on that?
I think those kind of questions would take, I think, a little bit longer to hash out than what we have time for in the half-hour thing. I think you could you could do warranties for as long as you want. And as far as an extended payment plan, again, you have a lot of creativity in terms of how you want to do payment with earnouts, or whether you just want to make payments, that sort of thing. So, probably need a bit more from a factual perspective to I guess, to fully answer that question. So,
Yeah. So how would you do that? So with a question like that, obviously it gets more involved. That this is where the one-on-one strategy session comes in. You would, what would you want? You'd want to you'd have some pointed questions about what's going on with the sale and all of that.
And what the goals are, when you plan on closing, that what kind of business it is, that kind of thing. So,
Okay. Excellent. David, wonderful information. I want to say thank you to everybody that's on here. Again, there's a link in chat if you want to get one-on-one with David. Go ahead and click on that link. There's a short questionnaire there to fill out, probably take you 5 minutes, online questionnaire. Then it's David's calendar. I'm happy to give you any input that you need, and keep in tune to our emails and our outreach, because we're putting on shows like this all the time. We're just always trying to get you white hot information that can help you in some way as an owner, as a family, as an entrepreneur. So thank you, David. Thanks. I know we're going to have you back on.
okay, sounds good. Thank you.
All right.